Devina Mehra, founder, chairperson, as well as MD at First Global, joins us on the show. Hi, Devina. Good morning. Good to see you win. What's your positioning now and how are you feeling about the Indian market? So many factors, right? At least the good news from the last time that we chatted is that crude oil prices have come off and the rupee has shown some signs of stability. So your approach?
Good morning and good morning to your viewers also. My stance has not changed much from earlier times, which is that, be invested to the extent of your equity portfolio. Equity allocation, March and April, I saw that the SIP ratio is kind of turning negative, that there are more SIPs that are coming to an end than new SIPs getting started. And that, unfortunately, is how most investors behave. So you see a nice compounding over decades in equity markets, but most investors don't see that because they probably get in and out at the wrong time. So my strategy remains the same. In the rebalance, of course, I mean, we just did a quarterly rebalance, so there have been some changes, but not very drastic changes this time. That's within sectors, within companies and all that.
Do you want to tell us, Devina, hi, morning, Rima here, about the rebalance that you've done and why, what prompted it, what were the trends that you've observed, what's the narrative behind that?
So nothing, special prompted it. We do it every quarter. So, and we do it from base zero. So the question we ask ourselves is that today, if we had cash, where would we be invested? Not starting from our existing portfolio, simply because, otherwise all of us suffer from something called endowment bias, that we always value something that we hold more highly than we should. I mean, the hold rating exists in the world because of endowment bias, because objectively, anything you will not buy today, you should not hold at today's prices. So this was a regular exercise, and we have been overweight auto components, autos, pharma for over 2 years, and one was thinking whether that story comes to an end. But right now, our systems are still showing stocks from that. So actually, in pharma, I think we've increased the allocation a bit, even though we were already overweight. Otherwise, there are a lot of bottom-up picks.
Devina, just to come in, autos, pharma, and what else were you talking about?
Components, more than also autos and pharma. And then, of course, there are bottom-up picks from places like chemicals, capital goods, FMCG, etc. As a pattern, we've seen a little more of the power sector coming up the system. So both power as well as power equipment. So, that's as a sectoral thing, that's what is emerging from our bottom-up picking. So that's broadly the strokes. But as I said, not very big drastic changes.
Devina, if the war comes to an end, do you see significant upside in the market from here on? Would it be 5%, 7%? Or do you think, because even prior to the conflict, the FIIs were still sellers in the Indian market? So what is your view? If the conflict comes to an end, what's going to be the impact and how much of the issues that we're facing are structural in nature?
We're mixing up two things, whether FIIs come back or not and whether the markets go up or not. These are two completely separate things. As I've said often enough that if you map it over a long enough period, there is actually no correlation between FIIs buying and selling and the market moving in whichever direction it does. So, and on the geopolitics, my stance had been right from the beginning of this conflict, or for that matter, 4 years ago from the beginning of the Russia-Ukraine conflict, and this is based on data of 125 years of data, that you should not react too much to geopolitics unless your country is at war. Because that is what the history tells us, and not in a statistical sense, but in every single war. So here, of course, crude was already sort of due for an up move. So in our February rebalance, for instance, in our global funds where we were already underweight US equities, we had further underweight US equities and put that money into commodities, so mainly oil and some metals. So that pattern had emerged. And yes, I mean, it is good on the corporate earnings front if crude comes down, because a lot of downstream products from crude are inputs for many industries. So, it will accelerate the earnings trajectory a bit. And Q4 also, the earnings were not bad. So, I mean, we were expecting some kind of impact, which I think you might still see on the Q1 earnings because of this crude and downstream petrochemicals. But overall, of course, I mean, we are crude importers, and so that for us as an economy, it's a positive.
Okay, all right. Devina, let's focus on a couple of segments then. Auto ancillaries, if you could give us some color, what do you like? The auto ancillaries that are facing what kind of a theme? The CV space, do you think that's still strong from here on? Or, how would you position yourself?
So as I said, we've been overweight that theme for over 2 years. So from the beginning of 2024 almost, we've been overweight that. So it's not a new theme for us. And we don't believe in either excess sector concentration. So we'll never have like 30 or 40% in a single sector. And within a sector also, we have normally a range of companies. It is not just, one company or two companies. So our equity product is called India Super 50. So because we target to have about 50 odd stocks. So that's it's a broad theme. And as I said, since we've been overweight for over 2 years, I thought maybe that theme would be tiring. But for now, it's holding up.
Okay. And on metals, what is it? Ferrous, non-ferrous? Are you playing the gold finance companies, or I want some color out there since you'll have added some positions there.
Metals, we are not overweight, and we'd have, I think, a little bit of ferrous and a little bit of non-ferrous, but that's not a theme we are especially overweight. I just said that overseas, I mean, because you can play the commodities also, we had, and that was not the big chunk again in commodity. The big chunk was oil and energy, but we did buy some metals. As in terms of precious metals, I was just, taking a evaluation. Normally we have single digit allocation, but because the precious metals did very well last year and equities did not, we actually are in double digits just now in both our India fund as well as our global fund. So we just actually not in the global fund, but in India we are in double digit in precious metals. So we're just reevaluating whether to remain there or cut it back a bit.
Devina, how much of a negative would SIP ratios turning negative? I know we've seen only early signs, but you did say that this is a trend which happens when markets do nothing for a while. And plus, if markets recover a tad bit, we will see equity issuances come back. So that creates that supply pressure.
See, I mean, that's what I'm saying. Most retail investors enter and exit at the wrong time. I'll give you an extreme example. Many of your viewers would have read or at least heard of One Up on Wall Street by Peter Lynch. Now, he was almost the most successful mutual fund manager in American history. That fund compounded, I think, 28 or 29%. But the average investor in that fund compounded only 7%. And a good chunk of the investors actually lost money investing in the best mutual fund in history because they entered and exited at the wrong time. So you had years when that fund did very well, spectacular returns, and everybody rushed in. And often the very next year, there would be huge underperformance and people rushed out. So that's the unfortunate pattern. So all of us look at the 30-year chart and say, obviously, I would not have got out at the bottom or got in at the top. But your mind kind of panics and forces you to do the things you should not be doing.
Devina, were you placed on tech or a debate, right? Globally, AI trade doesn't slow down. In India, we have these tech companies that have underperformed. Which side of the argument are you on? Good time to look into it or stay away?
I have an op-ed coming out tomorrow on the global AI bubble. And I think it is a bubble. It's just a matter of when now. It's not if. And if you see, I mean, we think AI means the mega AI deployers, which is the Magnificent Seven, the big 7 stocks in the US. But actually, that bull has been tiring for a while. Even in 2025, 5 of those 7 underperformed the S&P. This year, 3 of them are down for the year. And the market has broadened there. The Russell 2000, which is the small cap index, has done more than double the return that S&P has. And even in what we now call AI is actually the CapEx people who are supplying for this AI CapEx. So there's like depending on which estimate you look at, something like $750 to $900 billion of capex being put in by these large companies. And therefore, everybody, hardware, networking, semiconductor equipment, they not only have great demand, they have great pricing power at present. But semiconductor companies like that sector historically has been a very cyclical sector, like most capital intensive industries. So this year you have the capex, but 2 years later, will you have the same level or higher level of capex for you to show the growth? So, I mean, I find it a little silly to look at that very simple PE by growth. People look at, yes, this year there is growth, but will it sustain? Because the problem is that these kind of capital investments will not get the return on capital. That is really the big question mark. That, yes, I mean, AI might thrive as a technology, maybe. I mean, again, all the people telling you the hype about AI are either the companies or early investors in their companies, and most of the so-called research reports are all research papers are not peer reviewed or any of that. So, I mean, you are talking to the companies who are raising money either in the private market or on the IPO market, and obviously they will hype up the technology. Whereas the user, like recently the Uber CEO said that we did not see the cost benefit playing out in AI. So that's the one part. As far as India is concerned, the India IT services companies, even if AI comes in, no chief technology officer is going to turn over the keys to their system and database to an AI company. They will still need an intermediary, because otherwise, AI can also cause havoc in your system. So I think, in terms of business, the IT companies in India will be able to pivot their business. The issue might be more for the macroeconomic front, that they may not be, at least for some time, the big employment engine they were for the last 25 years. And we are already not doing so well on the employment front.
Devina, a great conversation, and we look forward to that op-ed on AI. But thank you for giving us that sneak peak.
Thank you.
Great chatting with you.